For decades, the Midwest was America's unshakable housing market, a bastion of stability, a safe haven where home values climbed slowly, steadily, and without the wild recklessness of the coasts. But in 2025, that rock-solid reputation is cracking. The numbers are in, and what was once America's most predictable region is now flashing warning signs of a silent collapse. Home prices are no longer climbing, they are slipping, and fast. In states like Indiana, Illinois, and South Dakota, a shocking statistic is emerging. Over 50% of homes are now selling for less than their asking price, leaving sellers in a panic. The inventory of available homes is relentlessly rising, while crushing mortgage rates near 7% have mercilessly choked off buyer demand. This isn't just a slowdown, this is a profound shift in power. This is a silent collapse. Which Midwest states are at the epicenter of this seismic shift? Where is the safe haven narrative giving way to the harsh reality of a market in profound reversal? We're diving deep into the data, identifying where the housing market is bending, and in some cases, threatening to break completely. Get ready for a wake-up call that every homeowner, buyer, or investor needs to hear. Today, Discover the Nation unveils 10 Midwest states where the housing market is crashing hard in 2025.
Number 10. North Dakota. This state's housing market in 2025 is a fascinating contradiction. On paper, the average home value has risen by 4% year over year, which seems like a healthy gain. But beneath that deceptive appreciation lies a much more cautious and fragile market. The first killing indicator: nearly half of all homes sold in recent months, 49.1%, are closing for less than their list price. This is a powerful signal that sellers are losing their leverage and buyers are regaining control. Inventory, while still tight overall, has seen a noticeable increase of 12% year over year, giving buyers more breathing room than at the height of the frenzy. Homes that once sold in a blistering 9 days are now taking a more patient 16 days to find a buyer. This extra time on the market is making sellers nervous and forcing them to offer price cuts. For a median-priced home of $284,700, today's mortgage rates around 7% mean monthly payments of roughly $1,960. That's a staggering $700 per month more than just a few years ago, a brutal affordability hurdle for local buyers. While North Dakota isn't in a crash, the delicate balance of power is shifting. Its market is cooling quietly, and sellers are learning a hard new lesson in a post-boom reality.
Number 9. Nebraska. It may still feel like a safe haven in the broader U.S. housing market, but even here, the cracks of cooling are becoming undeniably visible. The average home value in Nebraska is currently around $278,000, representing a modest 2.3% increase year over year. On the surface, that might sound healthy, but this is the lowest rate of appreciation the state has seen in over 4 years. This once booming market's momentum is fading fast. What's even more revealing is that 48.8% of home sales in Nebraska are now closing below the original list price. That's nearly half of all transactions, a terrifying statistic that shows sellers are being forced to concede on price just to get deals done. The median days to pending has risen to 11 days, up from just 6 or 7 days during the boom. This means buyers are no longer feeling the intense pressure to act immediately. Affordability, once Nebraska's strong suit, is beginning to wear thin. A $278,000 home at a 7% interest rate will cost buyers about $1,915 per month, a crushing $745 monthly jump from what buyers paid just a few years ago. Inventory levels are creeping up slowly, a 10% increase year over year, and that added supply, combined with waning demand, is forcing widespread price corrections. Builders are beginning to pause some projects, especially in the starter home segment where buyers have become most rate sensitive. Nebraska isn't crashing, but the seller's market era is unquestionably and tragically fading away.
Number 8. Wisconsin. This state, often celebrated for its friendly neighborhoods, beautiful lakes, and robust economy, may not be grabbing national headlines, but its real estate market in 2025 tells a surprisingly dire story. The average home value across Wisconsin sits at approximately $333,000, which still represents a 4% year-over-year increase. But beneath that positive number, the data reveals an increasingly cautious buyer pool and a profound loss of market urgency. As of June 2025, the median days to pending is 17 days, a noticeable slowdown from the 8 to 10-day window seen during the 2021-2022 frenzy. Sellers are losing their advantage, especially in rural and mid-tier suburban areas. A full 40.4% of homes in Wisconsin are now selling below list price, a major and brutal contrast from just 2 years ago, when bidding wars often push prices far above asking. Inventory has also begun to rise, up around 7% year over year, giving buyers a bit more breathing room. However, mortgage rates hovering around 7% continue to mercilessly suppress affordability. For a $333,000 home, a 30-year fixed mortgage at 7% means monthly payments near $2,210, a shocking leap from about $1,580 just 2 years ago. If you're finding this crucial information for understanding America's market shifts, please gently hit that subscribe button to discover the nation. Your support is vital for our in-depth analyses. The 5-year trend line for Wisconsin still shows strong cumulative gains, but those curves are now flattening. The peak growth appears to have occurred in early 2022, and the state has been coasting on borrowed time ever since. For now, Wisconsin's market is bending, but it hasn't broken. But all signs suggest it is heading for a slow, silent collapse if high interest rates linger.
Number 7. Missouri. The Show Me State has long maintained a reputation for a stable, affordable housing market. But in 2025, that calm surface is being disturbed by the undeniable signs of a market that is no longer just cooling, but quietly sliding toward a significant downturn. The average home value across the state currently stands at around $262,000, which reflects a modest 2.3% year-over-year increase. But beneath that calm surface, subtle but important changes are underway. Roughly 46% of home sales in Missouri now close below the original list price, a clear and chilling indicator that sellers are conceding on price. The median days to pending is now 9 days, up from just 5 to 6 days during the pandemic boom. While 9 days still suggests a relatively active market, the upward trend is unmistakable. Sellers in cities like St. Louis and Kansas City are now encountering more cautious buyers, many of whom are either offering under asking or waiting for price cuts. Affordability is starting to bite. At a 7% rate, a $262,000 home comes with a monthly mortgage payment of about $1,800. That's up roughly $500 to $600 per month from the 2021 era. That extra monthly burden is a significant sting for working families earning Missouri's median household income of about $63,000. Inventory has grown slowly, but that added supply, combined with waning demand, is forcing painful price corrections. Missouri may not be experiencing a full-blown collapse, but it is cruising into a slow, quiet correction phase where the seller's market era has unquestionably faded, leaving behind a profound sense of uncertainty.
Number 6. Minnesota. This state's housing market was one of the Midwest's hottest between 2020 and 2022. But by mid-2025, the initial cracks of a deeper slowdown are clearly emerging. The current average home value stands at $351,500, showing only a modest 1.8% year-over-year increase, a big drop from the 10 to 15% surges seen during the pandemic. And perhaps more tellingly, about 37% of homes in Minnesota are now selling below list price, a grim signal that buyers have begun negotiating again, and sellers are losing their power. The median days to pending has climbed to 12 days, which is nearly double what it was just 2 years ago. This extra time gives buyers more breathing room, and it often results in price reductions. While Minneapolis-St. Paul remains a relatively tight market, outer suburbs and smaller towns are seeing homes languish much longer. Affordability is also beginning to bite hard. With a $351,500 price tag and a 7% mortgage rate, monthly payments reach about $2,420, a crushing $950 per month difference from just a few years ago. That's a difference that puts significant strain on first-time homebuyers and even mid-level earners. Inventory is slowly climbing, with about 22,000 active listings, and builders are responding by trimming prices and offering incentives. Resale homes, meanwhile, are seeing fewer bidding wars and more price drops. The curve of appreciation is flattening fast. While there's no full-blown collapse in sight, the red-hot growth days are over. The market is now stabilizing, but also shifting dangerously toward buyers, and if rates stay high, this painful trend will only deepen heading into 2026.
Number 5. South Dakota. The state's housing market might look stable on the surface, but a deeper, more chilling dive reveals signs of profound pressure building beneath. The average home value in the state currently hovers around $319,000, reflecting a modest 2.2% increase year over year. While prices aren't outright collapsing, momentum has clearly and dangerously slowed. A key indicator of this weakness is that a stunning 65.3% of homes sold in the past month closed below their original list price. This is a massive, shocking shift from the red-hot pandemic years when sellers called all the shots. Inventory is also beginning to rise, up nearly 14% from the previous year. Buyers now have more choices, and many are waiting for better deals, especially with mortgage rates still hovering near 7%. If you're finding this crucial information about America's market shifts essential for your understanding, please gently hit that subscribe button to discover the nation. Your support is vital for our in-depth analyses. For a typical $319,000 home, that means a monthly payment close to $2,115, up nearly $600 from just a few years ago. That affordability squeeze is crushing buyer enthusiasm. The median days to pending in South Dakota is now 18, double the speed of sales just 2 years ago. In many towns across the state, especially those farther from Sioux Falls or Rapid City, homes are sitting longer and price cuts are becoming more common. Builders have slowed construction, and while no major crash is underway, the balance of power is shifting dramatically. South Dakota isn't collapsing, but it's no longer the ultra-competitive market it once was, and it's firmly in the early stages of a transition toward a buyer-favorable market.
Number 4. Kansas. Kansas has long been known as one of the most affordable housing markets in the Midwest, a bedrock of stability. But in 2025, even this steady state is beginning to show profound signs of a market in distress. As of mid-2025, the average home value in Kansas is about $242,000, reflecting a 2.7% increase year over year. That's still a gain, but it's a clear deceleration compared to the 7 to 10% annual jumps seen just a couple years ago. What's more telling is that 41.9% of home sales in Kansas are now closing below the list price, a significant uptick from earlier in the decade when competition pushed most homes over asking. Even in popular metros like Wichita or Overland Park, buyers are no longer rushing. The median days to pending is 8 days, which still suggests a relatively active market, but longer than the 3 to 5 days that were common during peak demand. Affordability remains one of Kansas's strengths. At a 7% interest rate, a $242,000 home comes with a monthly mortgage payment of around $1,610. However, rising rates have still made a noticeable dent in local demand. That same mortgage would have cost about $1,020 just 3 years ago, nearly $600 a month less. Inventory is slowly rising, with about 14,000 homes on the market, up 10% from 2024. Builders are becoming cautious again, and price-sensitive buyers are asking for concessions. Kansas hasn't entered a housing crash, but the momentum is clearly fading. Price growth has plateaued, negotiation is back on the table, and buyers are no longer feeling the pressure to act fast. This is what the silent start of a soft landing, or perhaps something more profound, looks like.
Number 3.
Indiana. Indiana's housing market in 2025 looks calm at first glance, but the data reveals a gradual and profound erosion of seller power. The average home value in Indiana is now about $238,000, up 3.0% year over year, a noticeable slowdown compared to the high double-digit growth during the boom years. But here's the real chilling eye-opener. A staggering 51.8% of homes sold in Indiana closed below the original list price. That's more than half of all transactions, showing that sellers are now frequently conceding on price just to get deals done. The median days to pending now sits at 11, up from just 6 or 7 days during the pandemic-era frenzy. In major markets like Indianapolis and Fort Wayne, listings are lingering longer and the urgency among buyers is fading. Affordability, while relatively strong, is starting to bite. A $238,000 home at a 7% mortgage rate comes with a monthly payment of approximately $1,580. Still, that same home would have cost closer to $990 a month in 2021, making today's payments $590 a month more expensive. That monthly difference is brutally forcing many first-time buyers to reconsider or delay purchases. Inventory levels are climbing steadily, with about 21,000 homes active statewide, a 12% increase year over year. Builders are now offering incentives. Resale homes, meanwhile, are seeing fewer bidding wars and more price drops. The peak has passed, price growth has flattened, seller expectations are being brutally recalibrated, and more buyers are holding off in hopes of a better deal. While Indiana isn't in a full-blown correction, the shift from a seller's market to a buyer-leaning market is well underway, and the market's underlying fragility is becoming terrifyingly visible.
Number 2. Illinois. Illinois is one of the clearest examples of a Midwest housing market that's no longer climbing. It's leveling out, and in some segments, it's starting to fall. The average home value in Illinois is now around $267,000, which marks a 3.5% increase year over year. While technically still positive, that's a big slowdown from the roaring 10 to 12% growth rates the state saw during 2020 to 2022. And here's the ticker. A staggering 43.2% of homes in Illinois are now closing below their list price, meaning sellers are conceding almost half the time, a desperate signal of weakness. The median days to pending is currently 8 days, which remains competitive compared to national averages. However, this is significantly higher than the 4 to 5 day turnaround seen during the peak market. Buyers are no longer feeling the urgency to act on day one, and many are waiting for price reductions, especially in suburban areas or less competitive towns. Affordability is starting to strain budgets. At 7% interest, a $267,000 mortgage comes with a monthly payment of about $1,770, excluding taxes and insurance. That's a punishing $660 per month increase from just 3 years ago, which has priced out many middle-income households. Statewide active listings have climbed to about 30,000, an 11% increase over last year, showing that inventory is loosening. Over the past 5 years, Illinois homes are still up nearly 30%, but recent months show a dramatic flattening of that trend. The spring surge has failed to materialize in 2025, and the buyer pool remains cautious. Illinois isn't crashing, but it's undeniably leading the Midwest in shifting away from a red-hot market to something much cooler, much slower, and much more uncertain.
Number 1. Michigan. Topping our list as the single worst Midwest state where the housing market is crashing hardest in 2025, Michigan. Michigan's housing market is cooling faster and more profoundly than most of its Midwest neighbors. The average home value in the state is now about $262,300, reflecting a meager 2.5% increase year over year. Still positive, but tragically far from the explosive growth seen in previous years. A key red flag is that nearly 44.9% of homes are now selling below their list price, a terrifying signal that sellers are frequently forced to lower expectations to close deals. The median days to pending is 13 days, noticeably higher than the 5 to 7 days common during the market's 2021 peak. Even in traditionally strong areas like Grand Rapids and Ann Arbor, properties are lingering longer. Buyers are clearly regaining leverage and exploiting it. Affordability, once Michigan's calling card, is beginning to wear fatally thin. A $262,300 home at a 7% mortgage rate equates to a monthly payment of roughly $1,800, excluding taxes and insurance. In contrast, that same home cost $1,130 per month just 3 years ago. That brutal $670 monthly increase has pushed many out of the market entirely. Inventory has increased modestly but steadily, with around 24,000 active listings across the state, a 9% bump year over year. Sellers who once commanded bidding wars are now watching homes languish, especially in rural and older markets. The recent plateau is undeniable. While there's no dramatic collapse, there's a clear and profound reversal in momentum. Builders are cautious, price cuts are common, and buyers are testing boundaries. Michigan's market isn't falling apart, but the era of easy gains and lightning-fast sales is tragically and definitively over. It's now leading the Midwest in a profound and painful market shift.
The message from the Midwest is clear. The housing crash is no longer a prediction, it's a profound, silent collapse, unfolding in real time. Across these states, once considered America's safe havens, the rules of real estate have changed. For countless homeowners who bought at the peak, the dream of easy appreciation has dissolved into the harsh reality of a stagnant market, falling values, and the daunting challenge of selling in a new reality. The very pulse of these communities is weakening, replaced by an unsettling stillness. The common threads weaving through these struggling states are crystal clear: a loss of seller leverage, rising inventory, declining buyer urgency, and a palpable affordability shock. This is far more than just a slight adjustment. It's a profound, systemic market correction happening at an alarming and unprecedented speed, signaling a potentially new and much harsher era for real estate in the heartland. Stay vigilant, stay informed, and most importantly, stay prepared. The housing market is a dynamic and often merciless beast, and knowing its true, unfiltered pulse is your best and most crucial defense. Don't forget to like this video, share it with anyone who needs to see this vital information, and of course, hit that subscribe button to discover the nation. We'll see you in the next video, because sometimes knowing where to be cautious can be the best investment decision of all.